Have you ever wondered how the stock market works? It's a bustling world of numbers, charts, and dollar signs, and it might seem a little intimidating at first, but don't worry, we're here to break it down for you. Imagine the stock market as a bustling marketplace, but instead of buying fruits and vegetables, people are buying and selling shares of companies. These shares represent a piece of ownership in a company. When you buy a share, you're essentially buying a tiny piece of that company. You become a shareholder, a part owner of the business. Pretty cool, huh? Now, why would people want to buy these shares? Well, the main reason is to make money. If the company does well, the price of its shares goes up. If you sell your shares when the price is higher than what you paid for them, you make a profit. That's the basic idea. But there's more to it than just buying low and selling high. The stock market is a complex ecosystem, influenced by a multitude of factors. Everything from global events, economic indicators, to a company's financial health can affect the price of a stock. It's like a giant global game of chess, with millions of players making moves every second. But here's the exciting part. Understanding the stock market can offer many financial opportunities. It's a way for you to grow your money, invest in businesses you believe in, and even prepare for your future. It's not just for Wall Street tycoons in fancy suits. Anyone can participate, even you. And remember, the stock market isn't a get-rich-quick scheme. It requires patience, research, and a bit of courage. But with the right knowledge and tools, you can navigate it confidently. So the stock market is not as complicated as it seems, right? Let's dive deeper. Next, we'll explore dividends, IPOs, and market fluctuations, demystifying these terms in a beginner-friendly way. Stay tuned. Ever heard the term dividends and wondered what it means? Well, you're in luck, because we're about to dive into it. Picture this. You're a fan of a band, let's say it's called the Apples, and you decide to buy their album. Now imagine if the Apples decided to reward you for your support by giving you a slice of their concert ticket sales. That's essentially what dividends are in the world of stocks. Dividends are a portion of a company's earnings that it decides to share with its shareholders. Think of it as a thank you gift for believing in the company and investing in it. Let's use a real-world example. Yes, you guessed it, Apple Inc. If you own Apple stocks and the company makes a profit, they might decide to distribute a part of that profit to their shareholders as dividends. So in a way, owning stocks in a profitable company can be like having a small stream of income thanks to dividends. But here's the catch. Not all companies pay dividends. You might wonder why. Well, it's a business decision. Some companies might choose to reinvest their profits back into the business, aiming to grow more and increase the value of their stocks. This is especially true for young, fast-growing companies. They might believe that using the money to fund research or expansion will benefit shareholders more in the long run, as it could lead to an increase in the stock's price. So, whether a company pays dividends or not depends on its financial strategy and its stage in the business life cycle. Mature, stable companies are more likely to pay dividends, while younger, growth-oriented companies might reinvest profits back into the business. As an investor, it's important to understand this and choose stocks that align with your financial goals. So, dividends are like your share of the company's profit. Pretty cool, huh? Whether you're aiming for immediate returns through dividends or long-term growth through reinvestment, understanding dividends is a key piece of the stock market puzzle. What about IPOs? Ever heard of that term? Let's take a moment to unravel this mystery. IPO stands for Initial Public Offering. Now that might sound like a mouthful, but it's actually pretty simple. It's the process by which a private company says, "Hello world," and goes public by selling its stocks to the general public for the very first time. Imagine a promising startup, let's call it Techie Teapots. They've been brewing some groundbreaking tech in teapots, but they need more money to boost their operations, research, and development. So they decide to go public. They do this by hosting an IPO, selling shares of their company to people like you and me. As we buy these shares, Techie Teapots gets the capital it needs to continue innovating and growing. And we, the shareholders, get a slice of the pie. If Techie Teapots does well, the value of our shares could skyrocket. But here's the kicker. IPOs can be a gamble. It's like buying a mystery box. You might get a golden goose, or you might get a box full of rocks. The company could flourish, making your shares worth more than what you paid for them. Or it could flounder, and your shares could end up worth less. It's a bit like a roller coaster ride with potential highs and lows. And don't forget, when a company goes public, it's under the watchful eyes of regulatory bodies and must adhere to strict rules and regulations. This is done to protect us, the investors, and ensure the company is playing fair. So is diving into an IPO right for you? Well, that depends on your appetite for risk and your faith in the company's future. It's always a good idea to do your homework, understand the company's business model, and consult with a financial advisor if you need to. So an IPO is like a company's debut on the stock market stage. Exciting, isn't it? Now, what about market fluctuations? Sounds fancy, right? Let's break it down. Imagine you're on a roller coaster ride, the thrilling ascents, the heart-stopping descents, the unexpected twists and turns. That's exactly what market fluctuations are, the ups and downs in the value of stocks in the market. So, what makes this roller coaster move? Well, it's a mixture of many things. Economic news is a big one. Picture this. You're lounging on your couch, scrolling through social media, and suddenly you see a headline. Economic growth exceeds expectations. This positive news can cause a surge of optimism among investors, prompting them to buy more stocks, and voila, the stock prices go up. Then there are company earnings reports. Let's say you've invested in a company that makes the best chocolate chip cookies in town. Now, if they announce that they've sold a record number of cookies this quarter, it's like a stamp of approval that they're doing well. As a result, more people might want a piece of this cookie company, and up go the stock prices. But remember, it's not always sunshine and rainbows. Global events can also trigger market fluctuations. Imagine there's an unexpected political event or a natural disaster halfway across the globe. This can cause uncertainty among investors, leading to a sell-off and causing stock prices to plummet. Navigating these fluctuations can be tricky. It's like trying to predict the weather. You can have the best weather app on your phone, but sometimes a sunny day can turn into a downpour in a blink. That's why, as an investor, you need to be prepared for these changes. It's all about staying informed, making thoughtful decisions, and not letting the fear of a little rain keep you from enjoying the ride. So, market fluctuations are like the stock market's mood swings. You never know what's going to happen next. But remember, every roller coaster has its ups and downs, and the thrill lies in riding it out. So buckle up, keep your eyes open, and enjoy the ride. So, we've covered a lot today, haven't we? We've embarked on an enlightening journey, beginning with the stock market as a bustling marketplace for buying and selling company shares. We've seen it as a global meeting point for investors, where business ownership changes hands and fortunes are made, or sometimes lost. We then dove into the world of dividends, a slice of a company's profits that it shares with its stockholders. We learned that dividends are like a thank you note from the company, a little extra something for believing in their vision and investing in their growth. Next, we catapulted ourselves into the exciting universe of initial public offerings, or IPOs. We saw them as a company's grand debut on the stock market stage, a pivotal moment when a business decides to go public, inviting everyone to own a piece of their dream. This is where companies can raise capital for expansion and where investors get first dibs on new stocks. And finally, we rode the roller coaster of market fluctuations, those inevitable ups and downs that make the stock market a thrilling, sometimes nerve-wracking adventure. We learned that various factors, from economic indicators to world events, can cause these fluctuations. But remember, it's these very fluctuations that can present opportunities for savvy investors. So where do we go from here? Well, the world of stocks is vast, and there's always more to explore, more to learn. So why stop here? Continue your journey into this fascinating world. Read up on different investment strategies, learn about different sectors, and maybe even try your hand at some mock trading. Remember, understanding the stock market is a key step towards financial literacy. Keep learning, and who knows, you might just become the next Warren Buffett.